Sure. But I do think that the hollowing out of the downtowns in the United States and elsewhere in the world is going to be quite significant and quite unpleasant. I think the country will get through it all right, but as they say, it will often involve a different set of owners.
Yeah, and the buildings don't go away, but
the owners do.
Well, but most people like to buy with non-recourse in real estate. And
billionaire investor Warren Buffett has sounded the alarm, raising serious concerns about a potential crisis in the United States real estate market. What's causing this worry is a massive debt load of a staggering $1.4 trillion, casting a gloomy cloud over the real estate sector's future. This financial storm, born out of overwhelming debt burden, is already making waves in the market. But according to Buffett, this is just the tip of the iceberg regarding the repercussions triggered by the real estate bubble. Charlie Munger, who has been Buffett's trusted partner for a long time, shares these concerns. He's particularly worried about a crisis in the U.S. commercial property market. Munger has pointed out the precarious situation of American banks, which are grappling with what he describes as bad loans, especially as property prices continue their descent. The commercial real estate landscape is currently undergoing a turbulent transformation, and there are clear signs that significant losses lie ahead. As the crisis deepens, certain sectors and geographic regions appear especially vulnerable. Downtown areas in the U.S. and worldwide are witnessing a noticeable decline, signaling significant and unwelcome changes. While the nation is expected to weather this crisis, it will reshuffle property ownership, with new individuals and entities stepping in as the new caretakers of these buildings.
Well, Berkshire's never been very active in commercial real estate. It works better for taxable investors than it does for corporations taxed the way Berkshire is. So I don't anticipate huge effects on Berkshire, but I do think that the hollowing out of the downtowns in the United States and elsewhere in the world is going to be quite significant and quite unpleasant.
Buffett has pointed out that his conglomerate, Berkshire Hathaway, has traditionally stayed away from heavy involvement in commercial real estate due to tax implications that favor individual investors over corporations like Berkshire. Consequently, the anticipated fallout from the real estate crisis is unlikely to significantly impact Berkshire's operations. For the past 15 years, the U.S. real estate market has thrived on cheap debt. The federal fund's effective rate, which essentially represents interest rates, has mostly remained close to 0% during this time. These historically low interest rates have played a pivotal role in driving the growth of the real estate market by incentivizing borrowing and investment. Imagine someone in your town wants to buy an office building for a nice, even price of $1 million. Most likely, this person doesn't have $1 million sitting around in their bank account. So, what they usually do is go to a bank to get a loan to help pay for most of the building. In this case, let's say the buyer puts down $350,000 as a down payment, like when you put money down on a house. Then, they go to a local bank to borrow the remaining $650,000. Now, whether this purchase turns out to be a good deal for the buyer depends on a few things, but one of the most important is the interest rate of that loan. Think of this interest rate as the cost of borrowing money. For example, if the buyer gets a loan with an interest rate of 5%, they have to pay 5% of the total loan amount in interest to the bank every year. It's kind of like a mortgage payment for a home. At a 5% interest rate, the yearly interest payment to the bank is $32,500. Whether the buyer can pay this amount depends on how much money the building makes. This is called the net operating income, which is just the money the building earns from rent minus all the expenses for owning and running the building. If the building makes enough money to cover the $32,500 interest payment, then it's a good deal. But if it doesn't, the buyer might have a problem. In our example, let's imagine there's an office building that brings in $60,000 each year for its owner. This money is what the property makes after all of its expenses. Now, this is good news because it means a property can easily pay off its debt. When people want to buy a property like this, banks use a special number called the Debt Service Coverage Ratio, or DSCR for short. They use it to see if it's a good idea to give them a loan. Think of the DSCR as a way to check how much extra room the property has to make its loan payments, especially if something goes wrong. To find the DSCR, we take the income the property makes, which is $60,000 in our case, and divide it by the yearly debt payment, which is $32,500. When we do the math, we get a DSCR of 1.85 times. Banks generally like to see a DSCR higher than 1.2 times. So, with an interest rate of 5% and an income of $60,000, this property easily meets that requirement. This low interest rate also makes buying this property a smart move for the buyer. Even though they borrowed a lot of money from the bank, they still make a good profit. But here's where things get tricky. In the United States, when regular folks buy a house to live in, they often get a 30-year fixed-rate mortgage. That means that the interest rate they pay on their loan stays the same for the entire 30 years. That's nice because it means their monthly payment doesn't suddenly go up. Now, when someone buys a commercial property like our office building, it's a bit different. The interest rate on their loan doesn't stay fixed. Instead, it can change every 3 to 5 years. Or it can go up or down based on what the current interest rates are. This can be a big problem for commercial property owners because if the interest rate goes up a lot, their monthly payments can get much bigger, and that can really be tough to handle. So, while low interest rates are great for buyers, they need to be prepared for the possibility that rates might go up in the future, which could affect their finances. Let's get back to our $1 million office building example. Imagine you borrowed money to buy it, and the interest rate on your loan was 5%. That means you had to pay $32,500 every year to cover the loan. So far, so good. Now, make things a bit tougher by raising the interest rate to 7%. Suddenly, your yearly loan payment jumps to $45,500. It's more expensive for you to own the building now. But as long as the money you make from renting it stays the same, you can still manage. But if the interest rate climbs to 9%, your annual loan payment skyrockets to $58,500. Your income from the building is $60,000, which seems okay at first, but here's the problem. Fewer people want office spaces because more folks are working from home. So, let's say your income drops to $40,000 because some tenants leave. Now, you're in big trouble. You can't afford the $58,500 loan payment anymore. This could lead to the bank taking your building away and selling it to someone else for way less than what you paid for it. This is what Warren Buffett meant when he said, "Buildings don't disappear, but owners can." It's a reminder that handling your debts and adapting to changes in the market are crucial in real estate.
Most people like to buy with non-recourse in real estate. And one time I asked Charlie, there was some real estate guy we were talking to, and how do they decide how much a building like this is worth? And the answer is it's whatever they can borrow without signing their name. And if you look at real estate generally, you'll understand what the phenomena that's happening if you remind yourself that that's the attitude of most people that have become big in the real estate business.
Here, Buffett explains that in the real estate world, many people prefer to buy with non-recourse debt. This means they're not personally responsible for the loan, unlike when you borrow money to buy a house to live in. When you buy a home, you sign a personal guarantee, which means you have to pay back the bank no matter what happens to the house's value. For example, if your house is worth $400,000 with a $400,000 mortgage, and the value drops to $300,000, you're still responsible for the full debt. In commercial real estate, things work differently. Large properties like office buildings or apartments are often bought with non-recourse debt. Here's how it goes. A big real estate firm buys a $50 million property, putting in $10 million and borrowing $40 million from a bank. After a few years, the loan's interest rate resets. But now, the property's value has fallen to $30 million. Because it's a non-recourse loan, the owner can simply hand the keys back to the bank and walk away. They lose the $10 million they invested, but the bank is left with a property worth less than the loan amount. Since it's a non-recourse loan, the bank has no choice but to absorb the loss. This isn't just theory, it's happening in real life. There's around $1.4 trillion worth of these loans maturing over the next couple of years. Many of these properties aren't worth what they were bought for, and they can't handle the higher debt payments due to the rising interest rates. Consequently, a significant portion of these properties will likely end up in foreclosure. We're already seeing the early stages of this unfolding, as evidenced by Starwood. A major real estate investment company recently ran into big trouble. They couldn't pay back a whopping $212 million loan that they had taken for an office building in Atlanta. This office building used to be prized property in a city that was growing very fast. However, things have taken a bad turn. The building is now only 60% full, down from 90% when Starwood got the loan in 2018. It's become so much less valuable that Starwood decided not even to try to talk to the lender to work something out. Instead, they basically gave the building back to the lender and walked away. This might be one of the first stories like this, but it probably won't be the last. The impact of these kind of failures will probably last a long time and affect more than just the real estate market.
Well, we're not through with bank failures, but we are through the depositor. The depositors haven't had a crisis. The owners of banks may have lost a hell of a lot of money. The people who bought the debt of the holding company, they may lose a lot of money. People can lose a lot of money, but the depositors aren't. And so you don't need to turn a dumb decision by managers into a panicking the whole citizenry of the United States about something they don't need to be panicked about.
To understand why this matters so much, let's look at the banking system in the United States. You might think that big banks, like the ones you see in skyscrapers in New York, are the ones who lend the most money for real estate. But surprisingly, that's not true. Most of the loans for buildings and property are made by small banks in different regions and communities across the country. In fact, these smaller banks make about 2/3 of all these kinds of loans. So, when something goes wrong, it's not the big Wall Street banks that suffer the most. It's the small banks that have been lending most of the money. Now, here's the part that affects regular people like you and me. These small banks also help small and medium-sized businesses in their areas. While big banks deal with giant companies you might have heard of, like Apple or Amazon, these smaller banks work with smaller businesses that make our towns and cities run. Think about your local bakery, your neighborhood auto repair shop, or the small tech company down the street. These businesses are the engine of many communities. So, when these small banks take a hit because of real estate loans gone bad, it doesn't just hurt the bank. It also hurts the local businesses that rely on these banks for loans and other financial help. This is where things could get tricky. Even if these small banks don't completely collapse, they might become more cautious about giving out loans to businesses. They might worry about losing money, so they could start saying no more often when a local business wants to expand or improve. Imagine you're the owner of that local bakery, and you want to open up a new branch in a nearby town. Normally, you'd go to your local bank for a loan to make it happen. But if that bank is being careful because of losses from bad real estate loans, they might say, "Sorry, we can't help you right now." This means you might have to put your plans on hold or find a way to borrow money somewhere else, which can be tough. Now let's zoom out a bit. If many small businesses in your town and other towns can't get loans to grow, they won't hire as many people. When businesses don't hire, there are fewer jobs available. Plus, when businesses can't invest and expand, they can't buy as much stuff, which can slow down economic growth. So, in simple terms, this real estate problem could lead to fewer job opportunities and a slower economy, which affects everyone. We can't predict exactly how things will play out in the real estate market, but one thing is certain: there will be challenges ahead. As Charlie Munger wisely said, there's going to be a lot of pain. The question is, who will feel that pain the most? It's a reminder that when things go wrong in one part of the financial system, like real estate, it can have a domino effect on other parts, like small businesses and jobs. Only time will tell how this all unfolds, but it's something we should keep an eye on because it could touch all of our lives in some way.